Hello there everyone, today's video is all about gifting shares to employees. So let's say you've got key members of staff in your business and you've looked at various other options of incentivizing these employees and considered things like share options, EMI share options and what have you, but you've decided that actually the best thing that you can do strategically is simply to gift shares to your employee. Gift them a minority percentage, let's say it's 10% of your business, on the hope that through their continued efforts, they will have a serious hand in helping to grow the business so that when you sell it at the back end, you all reap the rewards. But this person is crucial, so you decide to gift the shares. So what exactly do you do? How do you go about it? Well, the first thing is you would issue new shares. So let's say you had 100 shares in issue and you were the sole shareholder. Rather than you gift 10% of your existing shares, so you wouldn't gift 10 of your 100 to this employee, because that would be an event for capital gains tax for you, offloading your shares. Instead, you would issue new shares. So kind of working backwards, you'd say, well, how many shares do we need to issue so that the employee has 10% of the larger pot? Larger number of shares. It's about 11 shares, isn't it? So you've got 111 shares now in issue. They've got 11. So you issue those 11 shares. That would be 10% of the share pool. So issue new shares. That's the first thing. What else? Not transfer existing shares. So there are tax implications of gifting shares. So this employee has been given these shares for no consideration. They haven't paid anything for them, but they have to pay PAYE. There has to be PAYE on the market value of those shares. So that's a long established rule in the tax world. It was established in the courts about 100 years ago, actually. It's quite a famous case amongst tax advisors that said, look, when you're gifting shares, PAYE on the market value of those shares. So what you then have to do is say, well, what's the market value of the shares? So you need an accountant or a business valuer, someone to value your business at the point of gifting those shares. Now remember, 10% of a business, when you're valuing it for this purpose, is not 10% of the prorated amount. Because what can you do with 10%? You can't block special resolutions. There isn't a lot of power, a lot of sway in having 10%. So actually, the true value in isolation of a 10% minority share is a lot less than 10% of the full amount. Now, compare that to, let's say, at the back end, when you want to offload your business and you're selling shares in your company, you've got 90%, your favored employee's got 10%. At that point, they will get 10% of whatever the proceeds are for the whole thing. That's different. But for now, for the point of them acquiring these shares, being gifted them, the valuation principles are completely different and they are heavily discounted, which is good for them. The fact that they have to pay less tax, like we said, there's PAYE on the gift of the shares, but because they are heavily discounted, the tax is obviously less. So for example, let's just pluck some numbers straight out of the air. Let's say the business is worth £1 million. And you go through this exercise and you say, right, we need to value a 10% minority share for this employee. First of all, you would say, right, what's the pro rata amount? 10%. It's 100 grand. But like I said, it doesn't stop there. You then knock big chunks off that to reflect the fact that 10% doesn't have a lot of sway. So actually, the discount factor can be up to 75%, which is a big reduction. So 100 grand would give you the pro rata amount, 75 grand reduction. You could safely argue to HMRC that the value of those shares for the individual, 25 grand. And PAYE would apply at their marginal tax rate to that 25 grand. That's what the gift of those shares is worth. So there you go. However, that's great, but there's still some tax charge. And the employee, you might say, well, actually, the The employee might be a bit disgruntled if they've got to shell out PAYE on 25 grand. You know, what if they're a 40% taxpayer? You know, that's over 10 grand. So what a lot of people tend to do, you don't have to do, but if you don't want them to suffer that PAYE, you could, as part and parcel of this arrangement of gifting them the shares, issue them a bonus. So just a regular bonus, and that bonus, the net amount after PAYE on the bonus is enough to cover the tax bill on the market value of those shares that they've been gifted. So, you know, you would actually vote the bonus, and of course it's tax deductible for you as the employer. So it goes through the accounts in your P&L like other wages and salaries amounts would, and at least you're getting corporation tax. So to all intents and purposes, the employee isn't suffering any tax themselves on being gifted the shares in your company, because that extra bonus that they wouldn't have ordinarily had, the net amount after tax is paying the tax on the shares, on the market value. So that's how most people do it. What else do I need to tell you? Heavily discounted, we talked about that. Documentation, you've got to get the documentation right. Shareholders' agreements. Now, the last thing you want is, what if this employee, what if you fall out and they all of a sudden have 10% of your company and they go and do one? What can they do? You don't want them selling their 10% to Great Uncle Bulgaria or whoever. You want shareholders' agreements locked in, preemption rights. You've got first dibs to buy back the shares. Good leaver, bad leaver provisions, all sorts of stuff to protect you as the employer if the relationship with your employee turns south and they've got 10% of your business at that point. So make sure you get proper legals in place to cover your back when you're doing this, all right? In Form HMRC, there are several formalities and several forms we're letting HMRC know, because basically what you want from that point onwards, once the employee has paid the PAYE on the market value of those shares, either covered by you issuing them a bonus or not, but from that point onwards, hopefully the shares will grow in value. That's the whole point of you doing this, that the employee helps you increase the value of your business over time. When you sell at the back end, you've made a few quid, you're going to be subject to capital gains tax on your shares, and the employee would want to also be subject to capital gains tax on the uplift in the value of the shares between acquiring them and selling them. And there are certain forms that you need to do to inform HMRC, certain rules around share transactions with employees. So you just got to get the paperwork right, basically. But listen, that's an overview on what to do, how to do it if you are gifting shares to employees. So remember, we're not talking about share options, EMI, company share option schemes, company save as you earn schemes. This is just purely gifting shares in your business to key employees. What do you do? What's the pitfalls? What do you got to watch out for? And what are the tax implications? So hopefully you liked this video. If you did, please do remember to subscribe. And as always, I'll see you soon.